Hey guys, Mike Mellinger here. Want to spend a couple minutes. Jeff, I know I've met you. Jeff is a really good resource to know, especially when it comes to South Carolina tax credits, where we tell a lot of people, especially when they're using accountants from other states, is that South Carolina is like a tax credit haven, has a ton of tax credits that a lot of people miss out on. And we're going to be talking about a couple of those today, I believe, and how to apply for those. Jeff, is that correct?
Sure. We're going to give a overview of the South Carolina jobs credit and then a brief update on the ERC.
Awesome. And then I know Stephen, could you introduce Stephen?
Yes, yes, definitely. I will. It's part of the presentation. He's got his own slide, I believe.
Awesome. Okay.
Well, Mike, I really appreciate you giving us an opportunity to share this information. I feel like a key part of my job is educating people on what opportunities are out there. As you'll see, a lot of companies are already engaged in activities that qualify them for tax credit, and they don't realize. And so it's always a great feeling to be able to connect the dots for folks and help them reduce their tax liability overall. Wanted to, that's our agenda. We kind of covered that already. And just a little bit of an introduction about us. Myself, I'm father of four, been married for a long time. Don't ask me how many years, it's been over a decade. But Iraq veteran, I've been in payroll, HCM world for nearly a decade, most recently with ADP, and I've been with Alpharesults for a little bit about a year now. And I've got to say, Alpharesults has been probably the best company I've ever worked for. Great people, integrity, very knowledgeable. Everyone is so helpful here. It's probably been the best job I've ever had. And Stephen MacNeil is a big part of our organization. And I'll let him introduce himself.
Yeah. Awesome. Thank you, Jeff. Thank you, Mike. My name is Stephen MacNeil. I've been with Alpharesults for about 21 months now. I came from a traditional background, a traditional tax background of CPA, had my master's in tax, my law degree, and I was a director of tax for the Howard Hughes Corporation, General Growth Properties, and over at ADP. And it was ADP where I got introduced to tax credits and incentives. And so I am in charge of Alpharesults operations and the delivery of all tax credits that come through our company. And I echo what Jeff said. The one thing that I love about Alpharesults is the integrity. And we do the right thing for the right reason. We make sure that we maximize the opportunity without exposing our clients or the CPAs that refer the clients to any undue risk or exposure, never pressured into exceeding what we are comfortable with. And so it has been a blessing to have joined the organization.
Well, awesome. Okay.
I couldn't agree more. And Mike, feel free to ask any questions, interrupt at any time. This can be as interactive as y'all want it to be. About Alpharesults as a whole, we've been around for 22 years, and our business has been centered around relationships, primarily with CPAs and their clients. We feel like that is where we've gotten the majority of our business, and we focus in on those relationships. And that trusted advisor kind of status is a very valuable thing to us. And so, to Stephen's point, integrity is huge, communication is huge, and we've been able to build a very successful business over the past 22 years on that. We don't do tax work. We're not a CPA, so we don't do any tax or audit work. I think that's important to point out. We're solely focused on tax credits and tax incentives.
Awesome. So in the CPA world, we would refer to Stephen as an emancipated accountant. So he's no longer doing tax returns. And so we actually So it's general dislike among accountants for people who are emancipated accountants, like lawyers. If you ever run into lawyers and see a lawyer that's running a business, they're always like,
Yeah, and to be
he's
honest,
crossed
Mike,
over to the other side. He's
Yeah.
smarter than us. So
it's challenging at times to bite my lip and knowing where I can speak and where I need to be quiet, because having that experience, and I always want to chime in, but being a boutique service provider of these credits and not being a CPA, we walk a fine line.
awesome. And one thing, Jeff, and tell me, I'm familiar with your market. This is what's the hardest thing about your business is actually getting people to believe the good news, right? I mean, for example, people listening to this webinar will be emailing out. They're always going to be thinking, gosh, there's a lot of pain associated, or I'm going to have to pay a lot of money. But your model, if I'm correct, is more or less, hey, we found some money on the ground. Let's pick it up and give it to you. And, oh, by the way, you can pay us out of that, right? So,
Yep.
having worked in the sale of intangible self-paying products before, it's actually pretty hard sale because there's always this distrust of something that you're something. So, I mean, and that's why it's important to have people like you, Iraq veteran, and people like Stephen, CPA representing your company, and a good track record like that, because people just, I mean, believe it or not, I've called people on property tax appeals where it was no brainer, and we were doing it on a contingent basis, and they were like, no, I think somehow you're screwing me on this. And I was like, okay, I'm giving you the money, you're paying me, right, out of that. But hey, so I'll let you continue. I just think that's the hardest thing is that, like on this credit, really that people don't know about it, and because of that, they're leaving a lot of money on the table.
Correct.
Exactly. And you're right. It almost sounds too good to be true. In our industry, sometimes that is the truth. It is too good to be true, but that's we'll reserve that conversation for the ERC update later on. But you're right. I mean, in this situation, it's everybody wins. The client wins, we win. The government wins as well, because the government has put these incentives in place to incentivize employers to do more of the activity that they are already doing or plan to do in the near future. So it's a win-win-win for everybody. And I think that helps to, I love that part about my job too.
And I'll add, the CPA really is a hero, in connecting the two, making sure that your client is getting every opportunity, available to them, and being rewarded for the activities that are being promoted.
Awesome.
All right, so let's dive into it a little bit. So the South Carolina New Job Tax Credit, I believe that this is one of the credits that flies under the radar, and people don't realize, just like what we're talking about, they don't realize that they have been doing things that qualify them already. And I'll give a little bit of a spoiler as we talk through this. Think about the last 7 or 8 years of doing business and how you've seen job growth, because we can go back and capture a lot of that job growth if it qualifies, and we'll go into a little bit more detail there. So there's a lot of South Carolina new job credit. So there's a lot of opportunity there. So the credit overview, it's a financial incentive that the state has put into place that rewards new or expanding companies. In order to qualify, you must create and maintain a certain number of net new jobs in a taxable year. So that's the key, net new jobs. These are not replacements. It's net new jobs. And that number of jobs is calculated as an increase in the average monthly employment from one year to the next. And a lot of this is work that we'll do on our end. We just need to know the numbers, and we'll do all the calculations for companies.
Yeah.
Eligibility. So a job credit is available to companies who are in one of these industries. It could be headquartered or location. So they could be headquartered out of state and still take advantage of this as long as they have a South Carolina tax liability. Nothing too surprising in this list: manufacturing, warehousing, distribution. banks, professional sports team. I think that South Carolina really wants to incentivize professional sports teams to come to South Carolina. I completely understand that. One point to point out on this is that you'll see tiers of the different counties, and tier 4 counties where the biggest opportunity lies. That's the only place where retail facilities and certain service related industries can qualify for this opportunity. So
And
the number, go ahead.
will we define as part of this? Do we go over what a tier 4, what the tier 4 is in South Carolina? Okay.
We will. We have a map, color coded map, so you can help identify some of the opportunities.
Awesome.
And this one I think is an important part right here, because I think a lot of people think, new job tax credit, oh, I've got to create 1 million new jobs probably to qualify for it. And that's not necessarily true. So if you have over 100 employees worldwide, then you have to create 10 net new jobs. But if you have under 100 employees worldwide, then all it takes is 2 new full-time jobs. That's pretty normal business operations for a lot of companies. If they're just growing organically, they're going to add 2 jobs here, 3 jobs there. So again, like, this is one of those incentives that you're probably already doing it and you don't realize that you can benefit from that.
And what's unique about South Carolina, you can have 2 part-time jobs created and that will equal 1 full-time job. So if you have 4 part-time jobs, you can meet that criteria for the 2 new full-time jobs.
Okay.
Yeah, that's a very important point to point out, because a lot of jobs are part-time. Now, we mentioned the tiers, and this is where you start seeing the real opportunity here. So tier 4 counties are going to be more of the rural areas, but that's where the biggest opportunity lies. $25,000 per every new full-time job that is created. And it goes down, tier 2, I believe you're in a tier 2 county, Mike. That's $2,750 per new full-time job created. But the key is, it's going to be for the next 5 years. So in this example below, you can see ABC Company, their warehousing facility in a tier 4 county, 12 new full-time jobs, which is not, a crazy amount of new jobs. That's a $300,000 credit per year for 5 years. And that adds up to be about $1.5 million that they can use to offset their South Carolina tax liability. That's a huge opportunity. And a lot of companies are probably thinking at this point, I don't have that much tax liability right now. We just started, or we're growing right now. There's a 15-year carry forward with this.
15-year carry forward. Yeah. And just to make sure I'm correct on this, I'm thinking the only place to use that credit is for your South Carolina income taxes. Is that correct? Okay.
That
you cannot
correct.
be used to offset payroll taxes.
Yeah, unfortunately, and that's one of the limitations of the job tax credit is it can only be used against 50% of the income tax liability. So in that example, with $300,000 of credit in a tier 4 county, I believe the corporate tax rate's 5% in South Carolina, and so doing the math, and you can offset 50% of that income tax liability. That's a pretty sizable taxable income in the state. And so the $20,000 and $25,000 credits look very attractive. It's going to be those unique situations in which a company will have sufficient taxable income to fully utilize those credits. Otherwise they may expire as carry forwards. But tier 1 and tier 2, especially if you're in a county that has a multi-county industrial park, because you can increase those credits by 1,000. So if you're in a county that has that agreement with another county, the tier 1 is actually worth $2,500 per new job. and tier 2 is $3,750 per new job. And so those numbers can add up quickly.
Well, one thing we're seeing, because South Carolina and a lot of other states doesn't recognize bonus depreciation, right? You have to take it over a period of time, and they don't recognize the QBI deduction. We are seeing that people in South Carolina tax liability sometimes, believe it or not, can be very rarely larger than their federal liability, especially if they're utilizing a lot of bonus depreciation.
Yeah.
Real hard to get that liability above the federal one. I mean, because South Carolina for a business is 3%. So for a flow through business would be a 3%. So it's really hard.
Right, pass through entity tax.
Mm-hmm.
Right.
Yeah, so we mentioned the map. I think this is a great visual, and you can see where the opportunity lies. Like I said, a lot of the rural areas is where the majority of the opportunity is as far as the size of the credit. But again, in other counties that are tier 2, even tier 3 is pretty high as well. But even a tier 2 county, you can have 10 new jobs. I mean, you're looking at a good amount of money over the course of 5 years. And this money is just sitting there, for the taking. Again, as long as you have a South Carolina tax liability. So the credits are very real, and this can also help in planning. And I think this is part of what the intent of this credit is for, is that if you're planning to expand, for example, we've got a trucking company that we work with for a long time here in Georgia. They're opening up a facility that is located in a tier 4 county in South Carolina, specifically to take advantage of this credit. So,
I'll
with you too, if you want to have this.
add one of the nice things about the new jobs tax credit in South Carolina is it's statutory. It's not negotiated. It's not discretionary. It's a statutory credit. So if you do XYZ activities, you get ABC benefit. And I love working with credits that are statutory, because there's no uncertainty as to whether or not you qualify.
Right. And I'm just actually sending some notes to Karen at my office about some tier 3 clients we have. I don't see any tier 4. Tier 4 is pretty tough. So union's growing a lot. So
what's nice about tier 4, retail establishments, service providers, CPAs, attorneys, they're able to qualify in tier 4 with as few as 2 new jobs. So there's some hidden opportunities there that I'm sure even escape the CPAs.
All right, so we'll talk about the timing of the tax benefit next. So the big question is, when can you actually benefit from utilizing this credit? And it depends on your size. If you have over 100 employees, or 100 or more employees, then it has to be used starting the first year in the tax year following the year of the job creation. But if you're one of the smaller companies under 100 employees, then you can utilize the credit in the year of the job growth. So you create the job in this year, and you can benefit from that job growth in the same year.
okay, great.
And Jeff, let me just chime in one thing. If you could go back to the previous slide with the counties. Okay, so the tier is established annually. So they'll re-review the criteria, and you might find certain counties that were tier 3 this year, maybe tier 4 next year, or they may drop to tier 2. So that gets published in January of each year. And so that's something to monitor. So you may have a situation in which you're a tier 2 and it's reevaluating, you become a tier 3. All of a sudden that job tax credit, jumps up in value potential.
Oh, yeah.
That's a great point. And Stephen, if you want to talk about the real life example we have here.
Yeah, so we had a manufacturer that over the last 7 years had qualifying growth in each of the years. And South Carolina has you're able to go back and amend for any open year, you can amend. So you go 3 years back. And so we're, 2019,
Mm-hmm.
yeah, 2019 would be the last open year. But if you had job growth in, 2017, 2018, those credits go for 5 years. You can go back, you can't pick up year 1 and year 2, but years 3, 4, and 5. And then the job growth from, 6 years ago, we're able to capture 3 years. So you do have to go back and amend the income tax returns for the open years, but you can capture growth going back, 7 years ago. And so that's something that, when we ask the clients for their payroll information, we're actually asking for 8 years of payroll so that we can establish, the base year and determine what that growth is for each of those years to see if there's an opportunity. Sometimes the credit's too small and the company doesn't want to, reopen a year, or they have a lot of shareholders and partners and they don't want to, amend,
Right.
Individual returns as well. But we were able to find an extra $70,000-$80,000 for that client for the open years.
One thing, Jeff, in your memory bank to make this easier for CPAs to use, I know you have some clear list of what qualifies, right, for businesses, but maybe even a more detailed list of what that means. Like I saw something called destination retailer. Is that like maybe one of these, but what does that mean? Is it like what does that mean? And then, but also businesses, that don't qualify would be good too, because I think we've looked at a few, but it'd be great to be able to go through your client list and say, okay, this one clearly isn't. The first limiting factor on this is the industry. Then the second limiting factor is what tier you're in. So that would be nice to have a more detailed, hey, these industry, we've done credits for these industries or this specific business, like, law firms. Law firms would only qualify in tier 4, right?
Yeah. So, and that's definitely something that we can put together and provide to you that helps you, review your client list to see where those opportunities may be. It's funny, the destination retail facility, if you read the requirements, it has to be a retail establishment within 2 miles of a major highway, and it just goes through this whole list of criteria.
What does the sales have to be? Because we had a retailer, I was sitting there when I first saw that, I was like, I wonder if that qualifies. And I was like, probably not. But counts what the definition of major highway is, right?
Right. I'm thinking you're probably a Buc-ee's would be nice. They just started that in Georgia, and it's a destination. Our kids will literally drive out of our way to go to a Buc-ee's.
Yeah, they're going to put one in South Carolina too. I wonder if they're putting it in a rural county.
It's a great question.
That'd be smart tax planning.
So any other questions on the South Carolina job tax credit before we move on to the ERC update?
Well, just what type of money did this manufacturer save? Did we cover that? Did they?
Yeah, I mean, what we were able to recover for those open years was between 70 and 80,000, and then we're looking at about 100,000 annually now.
Awesome, that's a lot of money.
Yeah.
And I believe they're in a tier 2 county. Is that right?
Tier 2.
Right.
Yeah, and the other thing to note is in 2019 the credits changed. It was not as lucrative prior to that time. So the first couple of years were a lower credit amount.
Okay. Awesome. Well, let's talk about a hot button, and we keep employee retention credit. I'm hoping that you can shed some light on people that qualify, people who don't qualify. I think I actually got a text message today from someone saying, oh, it's a government grant, calling the ERC a government grant. Call us, there's a new grant that's better than EIDL and better than PPP. And of course, I know they're talking about, they're trying to get you to call about the employee retention credit, which I clearly don't qualify for unless you guys are going to shed some light for.
I feel like as soon as this slide popped up, half the audience probably rolled their eyes because they're getting calls left and right from all these random people telling them that they qualify, and a lot of times they qualify no matter what's happening, in their life. And Stephen has been very invaluable. He's written an ebook about some of the scams that are going on, and I'll let him kind of give the overview. But the ERC is definitely hot button.
Can I get a copy of that ebook? Is it possible?
Oh,
Yes.
yeah, absolutely.
Yeah.
Yeah,
I'd like to-
I just recorded a 7-minute video as well talking about it. And this is a hot subject because, you're hearing, these commercials. I'm getting on my Facebook feed. I can't escape the ERC. Even, I turn off my computer from work and I'm still inundated with all this stuff. So, the purpose of the credit was to reward employers for continuing to employ their staff during the uncertain times of the pandemic. And the criteria in which to become an eligible employer, you had to have a significant decline in gross receipts, which is measured on a quarterly basis looking at 2019. And so if you had a 50% decline in 2020 in the same quarter compared to 2019, you qualified under gross receipts for 2020. In 2021, that threshold was 20%. So if you had a 20% decline in a quarter in 2021 versus the same quarter in 2019, you qualified. And there is an alternative measurement period, which is essentially the quarter before. So if you qualified in Q1 2021, you automatically qualified for Q2 2021. And then the other test, and it's an or test, it's not an and test. You don't have to have a significant decline in gross receipts and be subject to a governmental order. But if you have a governmental order that either fully or partially suspended your operations, due to COVID, that restricted or limited group meetings, travel, and commerce, then you'd qualify under the governmental orders test. Wages really depend on whether you're a large employer or a small employer. Large employer in 2020 was greater than 100 full-time employees, and in 2021 that was greater than 500 full-time employees. And it's full-time employees for 2019 is the measure. And what you're looking at is not full-time equivalents, but actually full-time employees. So 130 hours or more a month or 30 hours a week is a full-time employee. And so if you're a large employer, the eligible wages are wages paid to employees who are not working, who are not performing services. So you had a receptionist you sent home. She could not do her job from home because of telecommunications, but you continue to pay her. She wasn't performing services, but you paid her. Those wages are eligible for the large employer. Small employers, all wages are eligible. And when I say all wages, we have to go and balance those wages. If the company took PPP, we can't double dip. So we have to coordinate PPP wages and EOC wages. The same is true for the work opportunity tax credit, the R&D credit, the Families First Coronavirus Response Act, being the qualified sick and family leave. So, when I say all wages, it's all wages that were not used for one of these other programs. Qualified health plan expenses also qualify. And the credit potential is $5,000 per employee in 2020 and $7,000 per employee per calendar quarter in 2021. So with the exception of a recovery startup business, the credit ended after Q3 of 2021. So when you see those ads talking about 26,000, the math is 3/4, that's 7,000 plus the 5,000 for 2020. That gets you your 26,000.
Correct.
Okay, Jeff, next slide. So this is kind of the the running joke. Did you pay your employees during the pandemic? This little known governmental program pays you up to 26,000 per employee, but time is running out. Act now by calling us to claim these funds. It's repeat, and every company has the same verbiage. The IRS is onto these ERC mills, and they came out about 2-3 months ago talking about they are aware of some of the scams that are being taken, where the ERC mill is not properly qualifying the employer, taking not properly coordinating with the other programs, and filing these false claims. I have seen the report from some of these ERC mills, and in the report they're not talking about how the company qualified. They're not talking about the process that they use to establish what the eligible wages are, and it's difficult to connect the dots as to how they got the credit.
Mm-hmm.
And I have been told by a number of prospects, as we're talking to companies, that they talk to these firms and they say, were you impacted by COVID or by the pandemic? And the answer is yes. Well, then you qualify. They would ask, did you have any supply chain issues? And companies say yes. Well, you qualify. And that's not the case. Everybody was impacted by the pandemic. Everybody was impacted by supply chain issues. But in order, for the supply chain, in order to qualify based on supply chain, your supplier had to have been closed based on governmental orders.
Mm-hmm.
And so, the questions and the qualifications are really sketchy. And so,
Well, if I could say one thing, what I always do is I tell the client to look at their engagement letter, because I have a lot of clients like, hey, I think I qualify. You told me I didn't. I'm like, okay, let me see their engagement letter. And an engagement letter usually says, you told us you qualified. We're doing the calculation based on you telling us we qualify. And I was
your
like,
representation, yeah.
Yeah. And I always say, hey, we did a few of these ERCs based on these two programs. Okay. We did a few of them. I said, if you looked at our engagement letter, it clearly said, hey, we are determining you are eligible and we are going to calculate it. So here's the situation. Let's say we did it wrong. Okay. You being criminally liable for that is really impossible. Now, hey, they could hit you with penalties. Then I've got some civil liability for doing it wrong, right? But the truth of the matter is, on this one, when you're talking about $400, $500, $2 million, you better be, get a better engagement letter that says, hey, I'm a lawyer. I've come to opinion that you're eligible. And because they're charging a fee as if they have actually did some work and are taking some risk on it. And I think they are taking risk, because I think they've got some criminal liability for that. But again, I'm not a lawyer. But that's always what, and I have one of my clients who, he's like, oh, my buddy got $500,000. And then I said, send that engagement letter to your lawyer. His lawyer said, I would not sign that in a million years. And he was like, okay, I'm not doing it. Because they're still, I've sent some people to try to get qualified on supply chain, and they've all got turned down.
Yeah,
So
I have not been able to qualify anybody on supply chain.
So it's
unfortunately, a lot of these companies that are providing ERC services were created in 2021, 2020, specifically for the ERC, and the ERC is temporary. And so these businesses will most likely be gone once the ERC is gone, and you'll have no one to turn to.
And the fees, and they will have collected their 20 to 25% of your credit. And the truth is if they did it wrong, you're liable for 100% of it.
Yeah.
I
So
mean, the truth of the matter is, even if we did it wrong on the ones that we did, that clearly we felt qualified for reduction of sales, or a reduction of, or shut down by government, which in South Carolina was very unusual. I mean, you had to be, usually it was restaurants, health clubs. We didn't shut down a lot of businesses. So anyway,
well,
I'll let you finish, Stephen. Thanks.
yeah, no, Jeff, the next slide, please. Okay. So Mike, to your point, okay, how do you protect, yourself against the ERC mills and the scrutiny of the IRS? Get your CPA involved. Have them, review the agreement. Look at the basis, for qualification. Does it are they tied to actual orders? Okay. IRS Notice 2021-20 Q&As towards the end. It's like page 108. Goes through what is required for substantiation. And you want to make sure that, all these things are being identified. I have been told that, these ERC mills, are not tying it to any order. So you have to be careful, because when the order was put in place and then when the order was lifted, that time in between is your period of qualification. You don't qualify for a quarter before or after, those orders are in place. But
right, and so
you're
exactly tying it in like this. South Carolina, they had a list of all the executive orders, what date they were in, and what date they were lifted, and that's your qualification period.
right. And it's important to understand, the employee retention credit just got named to the IRS's Dirty Dozen tax scams. And that was, I believe, Monday of this week. Okay, so that there's a heightened sense of scrutiny on the ERC. We know that the IRS is going to look at it. But if the company qualifies, there is no reason not to take the credit. There are few times in your life where you're going to be truly rewarded by the IRS and the government for doing the right thing, and that's employing people during the pandemic. So there's no reason to forego the credit. But what you need to do is make sure that your I's are dotted, T's are crossed. The company that is calculating the credit, making sure that the orders, or if you qualify based on gross receipts. One of the things that I learned was, when I'd ask for gross receipts on a quarterly basis, and I would receive the gross receipts, and it would show that they qualified. I had to ask better questions. Did you provide me with the gross receipts on the same basis of accounting that you're filing your income tax return? Because a lot of times they're filing their income tax return on the accrual basis, but they maintain their books during the year on a cash basis and have their CPA do the cash to accrual adjustments at the end of the year. So, getting that information, making sure that it's the same basis of accounting that's being used. It really is. It's a legitimate credit. It is providing needed resources for companies looking to cover payroll, buy new machinery or new software, maybe expand a product line. These are real resources that can come back if you qualify. The key is making sure that the claim that you're filing for the ERC is legitimate. Okay, Jeff, next slide, please. Okay, and Mike, I've been working with the ERC, I was actually part of ADP's technical resources. So when it first came out, I've been involved since March 27th of 2020 with the ERC. If you have any questions that for me, or if the audience has any questions for me that you like to ask, I most of my day is spent answering questions on the ERC. I'm not sure what I'm going to do 2 years from now, but
hopefully not. The extension date ends for, I guess, 2020 and 24 and 25. But I do believe I just pulled up that Dirty Dozen about employee retention credits. And the IRS really in their dirty, I mean, it has a real narrow, it has the narrowest interpretation of the, hey, and they say you need to be tied to a government order and shut down or a drop in revenue. So anyway, I just think that's interesting. I do believe that there's going to be some criminal actions in this. I really do.
Absolutely. They've actually come out and said, there will be criminal prosecution, not only the employers, but these ERC mills. And so the CPAs are, a lot of times, they're the last line of defense for their clients. If you're asked to file an amended 941, for them, if you're asked to, you have the 280C adjustment. So there's an income add back for the credit. And so if you're doing an amended return to pick up the 280C adjustment, that's an opportunity, to take a look at the deliverable that the client received from the ERC provider.
Any questions? I'm not seeing anything pop up right now. If anything comes up later, feel free to reach out to myself or Stephen. But Mike, thank you so much for giving us the opportunity to come here. And it's always a pleasure to talk. I feel like I always learn something new when I talk to Stephen MacNeil. So I appreciate him joining us today. But
Stephen, and if I'm sorry, I apologize. Go ahead. If we get that, we had a lot of people sign up to get the email version of this. Love to include your ebook and maybe that even 7-minute video on ERC. Because that's what I was telling Josh today, because he's like, hey, I don't know if we have an hour. And I was like, here's the thing about the American public. The attention span is greatly decreasing by the moment. So keeping people's attention for an hour is a lot harder. I think the 7-minute and the ebook would be great. Because even when we see people watch the videos, it shows they're watching 10, 15, 20 minutes of it, sometimes speeding through. I'm sure the common habit that I do is I listen to everything at least 1.5 speed. But with that said, I definitely appreciate you guys. Looking forward to and getting that list of industry, because I've been teams and Karen, hey, we need to check with this client, we need to check with that client and see if they've had some job growth, some tier 3 stuff, hopefully that they qualify, right? And so you can help them. But that list of specific businesses would be great, because then we could put it in our checklist too.
Yeah, absolutely. We'll get that over to you, Mike.
But thank you guys so much. Appreciate your time, and I hope you have a wonderful day.
All right. Thank you. Take care.